This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Bring your A game. Apple, Amazon, and Alphabet report quarterly results, and their performance could have an outsized impact on the market.
Follow the money. Investors are plowing into stocks, and they're buying low-cost funds that invest in well-known indexes.
Mall makeover. As stores close, shopping centers have a new strategy to get back in shape. Those stories and more tonight on Nightly Business Report for Thursday, February 1st.
Good evening, everyone, and welcome. AAA, Apple, Amazon, Alphabet, three behemoths in the tech world, and they make up three of the four biggest U.S. companies by market value, each worth more than $500 billion. And they comprise a large percentage of the NASDAQ 100. That means their quarterly results, their outlooks, and what their executives say about business can sway the broader market. Tonight, we hear from all three.
And let's start with Apple, the world's biggest publicly traded company. Its flagship product, the iPhone, of course, has been a driver of growth. But in the latest quarter, which included the holiday season, Apple didn't sell as many as expected. In fact, iPhone unit sales fell 1%. Nevertheless, earnings in the quarter topped expectations. Revenue did as well, coming in at more than $88 billion, almost $1 billion a day. But the stock whipsawed in late-day trading. Josh Lipton is at Apple headquarters in Cupertino.
$77.3 million. That was the big number in Apple's latest quarterly report. Refers to the number of iPhones that Apple shipped in the quarter. Now, that was a bit light versus expectations. Analysts had modeled 80 million, but when people are buying those phones, they're paying more. We know that the higher price points for the 8 and the 8 Plus, and of course the flagship iPhone 10, which starts at $999. So the iPhone's average selling price clocked in at $796. That was better than the $756 that analysts had expected. For Nightly Business Report, I'm Josh Lipton at Cupertino, California.
Alphabet reached a new milestone. The parent company of Google cracked $100 billion in annual sales for the first time in its 20-year history. Its revenue in the most recent quarter beat Wall Street estimates, and its earnings results did not. And that sent shares initially lower in after-hours trading. Aditi Roy has more on Alphabet's quarterly results.
One of the key metrics analysts were watching on Alphabet was traffic acquisition costs, or TAC. Those are the fees that Google pays its distribution partners. They have been going up in recent years because of the rise in mobile and programmatic. Total TAC this quarter was $6.5 billion, slightly above analyst expectations of $6.28 billion. That is an area of concern for some analysts. On the other hand, for the first time in the company's history, Google hit annual revenues of $100 billion. And one other metric of note, the company reports the GOP tax plan resulted in an additional tax expense of $9.9 billion. I did ask Alphabet CFO Ruth Porat about whether the company might make an announcement about repatriation. She said that repatriation tax does provide a lot of flexibility, but that is more of a legal status than a change of investments. For Nightly Business Report, I'm Aditi Roy.
Well, Amazon reported earnings, $1.9 billion, that were better than analysts expected. Revenue for the quarter surged more than 30% because of a sharp increase in online shopping during the holiday season. And while you may know the company as an internet retailer, that's really not Amazon's profit engine these days. Its cloud computing business is, and it had a strong showing as well. That sent shares higher in initial after-hours trading. Deirdre Boza digs deeper into the results.
Another big earnings report from Amazon, driven by record holiday shopping season and continued growth of its cloud computing unit, AWS, or Amazon Web Services. Amazon also crediting the results to growth of its Prime membership program. Now, it doesn't break out the total number of Prime members, but Amazon did say that it saw more than 4 million signups in 1 week alone last quarter. Revenue from subscription services, which also includes music and video and other services, grew nearly 50% to $3.2 billion. It was also the first full quarter, including sales from Whole Foods after its acquisition last year. And that certainly came through in the recently added physical store category, where sales came up to $4.5 billion. The main takeaway, Amazon continues to grow sales and be profitable while spending big on newer businesses like video content, hardware, advertising, and brick and mortar. For Nightly Business Report, I'm Deirdre Boza, San Francisco.
So we've now heard from all the major tech giants. Let's go over some of the highlights from each company's performance and talk about what could be next. Joining us to do that is A.B. Mendez. He is a senior research analyst and fund co-manager at Frost Investment Advisors. A.B., great to see you. As always, welcome back.
Great to be with you, Sue. Thanks for having me.
Let me start out with Amazon because it is one of your largest holdings. What did you make of the report and what are you expecting longer term for the stock?
Well, from an investment standpoint, Amazon for the last year or two, for me, has been mainly about the AWS cloud business. It's been incredibly steady in terms of the growth, remaining above 40%, and the operating margins hanging right around 25%. We were expecting a slight uptick in the top line growth, which we got. 44% top line growth. That cloud business for Amazon now annualizes at more than $20 billion of revenue, more than $5 billion of profit. So another quarter of consistent profitability and slightly better growth.
AB, you've got your head in the clouds, man. You like Alphabet
Always.
partly
Always.
because of its cloud business. What did you see in their report today that impressed you or didn't?
Well, you know, we own all of Alphabet, Amazon, and Microsoft, and these are the three sort of hyperscale cloud leaders. In the Alphabet report, you know, it was a little bit less growth than we expected. Honestly, one of the interesting parts of Google's business has become sort of the other bets. So they have, outside of advertising and cloud, they also have self-driving cars, life sciences. So I've been paying attention to that line. But the cloud growth at Google was a bit underwhelming, maybe 35%.
And let me turn you to Apple because the stock has been under a little bit of pressure recently. There have been talks about the iPhone X not perhaps selling as well as many people had expected. But, you know, the report came in pretty good. How did you view it?
Exactly right. The revenues came in slightly above, you know, what the street was expecting, roughly in line with what we were expecting. And what it was disappointing unit sales and better than expected average selling price. And I think that means that the mix of the latest iPhone generation has been more heavily weighted towards iPhone X, less towards the 8. I mean, so we get more and more data points coming out of the Asian supply chain with each quarter that passes because that supply chain becomes more complex. And so there are more different touch points. So the data points ahead of the quarter were so uniformly negative that the actual number actually came in better than, you know, above a lowered bar.
I'm going to make you do a Sophie's choice here. We've heard from really the top five in tech over the past couple of days: Facebook, Microsoft, Alphabet, Amazon, and Apple. If you had to put fresh money to work right now in one of these, which would it be?
Tyler, I'm going to give you a Sophie's choice kind of answer for that question. I'd say across the board, I'm getting, you know, a little bit cautious on the market's valuation. So I'm being very opportunistic about when and where we put, you know, new money to work, or we are. But I'll just tell you that our largest holdings are Google and Amazon. I believe that the combination of hyperscale cloud computing and increasingly real and needle-moving artificial intelligence and machine learning that can make operations more efficient across enterprise computing, e-commerce, online advertising. This technology is actually becoming something that you know, is additive to both top-line revenue growth and operational efficiency in a number of different areas. So those two companies, Alphabet and Amazon, are far and away the leaders in that kind of technology, which has so many different applications, and that's one of the main reasons why they're our largest holdings in the large cap growth portfolio.
Good to see you again, A.B. Welcome
so
back.
much. Thank you. Yeah.
A.B. Mendez with Frost Investment Advisors.
The Dow component Visa reported a solid quarter late today. The world's largest payments processor saw profit up 22% as more people used its network. The company credited strong growth in the U.S. during the holiday season. That wasn't enough. The stock fell in initial after-hours trading.
Fellow Dow component Dow DuPont reported a rise in sales and beat Wall Street profit estimates. The chemicals producer was helped by a strong global economy that led to higher prices for its products. But the strong quarter was overshadowed by a disappointing earnings forecast for the year. That sent shares lower by nearly 3%, making it the worst performing Dow stock in today's trading session.
On Wall Street, meantime, stocks started the month of February struggling to hold on to gains after that very strong January performance. Now, the reason is a familiar one: higher bond yields. The yield on the 30-year U.S. Treasury security topped 3% for the first time since last May, and that did cap any stock market gains. The Dow Jones Industrials added 37 to 26,186. NASDAQ, though, off 25. S&P 500 fell 1.
Despite today's small market moves, money has been plowing into stocks. It was evident all of last year and continued into the start of this one. Bob Pisani takes a look at where all that money is going.
The economic news has been better. Tax cuts have helped corporate earnings, and money is just pouring into the stock market. ETFs had record inflows in 2017, and it's starting off with an even bigger inflow in 2018. $75 billion in January. Is that a lot? It sure is. The average inflows last year were a little over $40 billion a month. The money is coming into U.S. equity funds, but also into international funds that invest in Europe and emerging markets, because the global economy is expanding and earnings are going up overseas as well. What are investors buying? That's pretty simple. They want low-cost funds that invest in well-known indexes like the S&P 500, the Russell 2000, the NASDAQ 100, or some broad European index. They're cheap, and they are an easy way to get broad access to the markets. With rates rising, you'd think investors would be dumping bonds, but that's not happening. There were outflows from the largest corporate bond funds as well as high-yield funds, but the numbers are very small. Okay, so what would turn off this money spigot? Investors feel good about the economy and the prospects for corporate earnings. That's the impetus. There's no recession in sight. The only wrinkle is concern the economy rate run a little bit too hot, prompting the Fed to raise rates faster than anticipated. And that's been a rally killer in the past. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
Time to take a look at some of today's upgrades and downgrades. Chipotle was cut to sell from neutral at UBS. The firm cites heightened competition and says the company is facing a new normal of lower growth. The price target dropped to $290 from $345. Shares of Chipotle down 3% at $314.72. Express Scripts downgraded by Bernstein to underperform from market perform. The analyst there sees margin pressure from increased competition. The firm says that any benefits from tax reform are priced into the stock already. So what happened? The stock fell more than 1% to $78.10.
Goldman Sachs removed NVIDIA from its conviction buy list while maintaining a buy rating. The firm cites a 130% rise in the stock since December of 2016. The analyst also sees the possibility for increased earnings volatility. Shares of NVIDIA fell 2% to $240.50. Nike's price target was raised to $76 a share at UBS. That firm cites a return to U.S. growth and less promotional activity. The analyst maintains a buy rating on the stock. Nike shares, though, fell fractionally to $67.65.
And coming up, a package delivery giant disappoints investors. We'll tell you why.
It was a record quarter for holiday deliveries, but UPS failed to deliver for investors. The company issued a disappointing earnings outlook and announced plans to spend even more on network upgrades. That is not something that shareholders wanted to hear. The stock fell 6% in trading today. Morgan Brennan has the details.
For UPS, the spending didn't stop with the holidays. Despite an earnings beat, shares of the delivery giant plunged today after its 2018 profit outlook fell short of expectations. UPS expects big savings from tax reform, but it plans to funnel a big chunk back into its business. A bet that more capital spending will help it keep pace with more e-commerce shipments.
There's a tremendous opportunity in our industry. It's growing faster than GDP, and so we are investing to make sure that we not only have the capacity for this period, but for the entire year.
UPS plans to spend at least $6.5 billion this year, or nearly 10% of revenue, to expand its shipping network. The company's buying another 18 Boeing-made cargo jets and plans to open 18 new or upgraded facilities. including 3 U.S. ground hubs in areas where a spike in online shopping orders triggered delays last quarter.
We're a $66 billion company that grew last quarter by 11%. So we know the demand and the opportunity is there. A few years ago, we decided to invest in the international, and we're seeing the results today. And we're in the middle of investing in the U.S. domestic operations in a way that we haven't historically. And we're going to see the results and leverage created out of those investments.
Over the holidays, UPS delivered an eye-popping 762 million packages, 45% more than just 5 years ago. That growth has led to higher revenue and higher costs, including last quarter when bottlenecks after Thanksgiving weekend added $125 million in expenses. UPS, as well as rival FedEx, have already been spending billions to keep pace with surging e-commerce demand, cutting into profit and at times frustrating investors. Analysts say today's results show for UPS more still needs to be done. The question now, will Big Brown's big bets finally pay off? And if so, when? For Nightly Business Report, I'm Morgan Brennan.
Higher consumer spending helps MasterCard, and that is where we begin tonight's market focus. Despite offering more rebates and incentives last quarter, the payments company reported profits and sales that topped estimates as more customers made holiday purchases with plastic. MasterCard also said transactions in its foreign markets were up. Shares at a 52-week high, up more than 2% at 172.93. Weaker sales in the U.S. and abroad caused Hershey's results to disappoint. The candy maker's 2018 forecast didn't excite investors either. The company sees sales up 5 to 7%, while margins are expected to remain flat. Hershey couldn't sugarcoat the news, and that sent shares down about 6% to 103.77. Meantime, the health insurer Cigna said it would raise the minimum wage for its employees and increase retirement account contributions following those changes to the tax law. The company beat street estimates in the latest quarter, said its results helped by growing enrollment. Cigna also gave upbeat guidance for the year.
I think the question fundamentally for everybody in the space is, can you grow? Can you continue to innovate? And can you continue to deliver strong value? And we put forth an outlook for 2018 that indicates all of the above. So we're confident in the fact that we'll continue to grow the business and be rewarded by shareholders over time.
Shares fell about 1.5% to 205 and a penny. Alibaba reported a rise in revenue and profits that topped estimates as the e-commerce giant's annual Singles Day generated strong sales. Alibaba also said it would take a 33% stake in its payment affiliate, Ant Financial, in exchange for intellectual property rights. Alibaba down 6%, 192.22.
Cost cuts and an upturn in commodity prices helped ConocoPhillips' profits to rise to a level that impressed the street. The oil production company said a very successful year prompted the company to raise its dividend, increase its planned share repurchases for the year as well. Conoco shares were up nearly 1% to $59.35. Higher used car sales helped drive profits higher at AutoNation. The car retailer said customers are embracing its strategy of no haggle prices and its focus on selling pre-owned vehicles. Overall, AutoNation says it was a strong quarter.
The foundation, and first and foremost, is a record operating result in the fourth quarter, driven by revenue of $5.7 billion, a 4% increase. But more importantly, on a same-store sales basis, we increased gross profit by 7%.
But shares fell more than 3.5% to $58.04. And after the bell, the toy maker Mattel reported disappointing sales in a quarter the company typically brings in the majority of its annual profits. Demand for Barbie dolls did pick up, but other key brands failed to excite consumers. The toy maker also posted a loss, but said it is taking action to improve its profitability. Shares initially fell in after-hours trading. They finished the regular day down 3% to $15.32.
More evidence tonight that the job market is the tightest it has been in decades. The number of people who applied for unemployment benefits fell by 1,000 in late January, keeping the level now at a 45-year low. Tomorrow, the monthly employment report comes out. Expectations are for an increase of 177,000 jobs, with the unemployment rate staying steady at 4.1%.
Activity in the manufacturing sector cooled slightly last month, but less than expected. That's according to the Institute for Supply Management, which said new orders fell a bit, but remain at levels consistent with expansion. Employment in the industry is also expanding, and order backlogs are growing at a faster rate.
After finishing last year with strong sales, automakers have carried that momentum into 2018. In fact, January sales turned out to be a little better than analysts expected, and increasingly, Americans are paying more than ever for their new ride. Here's Phil LeBeau.
This is what happens when you have strong consumer confidence and a market where demand for crossovers, SUVs, and pickups shows no sign of slowing down. On the surface, January was a mixed bag by automakers, but each showed pockets of strength. Toyota sales jumped almost 17% thanks to a huge month for its pickup trucks. GM was slightly higher, with crossover sales spiking 20%. Ford saw buyers paying a record high average price. And although Fiat Chrysler's overall sales were down double digits, Jeep had its best January ever. Catch the theme here? America still has a big appetite for bigger vehicles. In addition, the new tax law may be convincing buyers they can afford to pay a little more for a new model, which raises the possibility the auto industry could post a fourth straight year of sales topping 17 million vehicles. But before you count on the auto industry having a big year, remember, January is typically one of the slowest months at dealerships. We'll see if buyers remain as hungry over the next couple of months. Phil LeBeau, Nightly Business Report, Chicago.
Separately, Toyota will recall 49,000 Prius and Lexus models for airbag issues. Some airbags might not deploy in a crash. Toyota says dealers will inspect and replace the bad airbag sensors for free.
Coming up, the new mall rat.
As more shoppers leave the mall to go online, landlords are trying to keep their malls alive. How do they do it? Well, a little exercise doesn't hurt. We'll explain coming up on Nightly Business Report.
Here's a look at what to watch for tomorrow. As we reported earlier, all eyes will be focused on the January employment report. Dow Components, Merck, Exxon, and Chevron will report their quarterly results. And the latest data on factory orders is also due out. And that is what to watch for on Friday.
eBay and PayPal will split after 15 years. The payment service operator will no longer be eBay's preferred provider. eBay has partnered instead with a Dutch company, which allows users to remain on eBay's website instead of being diverted to a separate PayPal site to settle up. PayPal CFO said the impact will be minimal.
eBay is a very large and important customer for us. We have to continue to work with them as we go forward, and we will continue to be a big part of their payments platform going forward. I wouldn't characterize it as a strained relationship.
But the stock was strained today, falling 8%, while eBay shares rose sharply.
Ralph Lauren, like many retailers, is seeing a drop in sales. After years of discounting, the company is now trying to wean customers off the deals they've grown accustomed to. But that is easier said than done. The company reported a bigger than expected decline in revenue during the crucial holiday season. Online sales also fell. That pressured Ralph Lauren shares, which fell more than 2%.
Well, as more retail moves online and out of shopping malls, landlords are looking for new ways to bring buyers in. Restaurants and entertainment were a start, but the latest strategy is really heating up and warming up shoppers in the process. Diana Olick is in Hyattsville, Maryland.
Monday, Isa is not a fan of shopping malls.
I only come to the mall when I come to the gym. Otherwise, I don't stop by this mall at all.
Thanks for coming in. I'm Coach Shanes.
Which is precisely why mall landlords like Philadelphia-based Preet, which owns 22 million square feet of retail space in malls across the Mid-Atlantic and Northeast, are actively recruiting fitness companies to fill their spaces. get them into the gym and back to the mall. The number of gym leases in malls nationwide has doubled in just the past 5 years.
People are not just taking up time at the gym here, they're going to the gym, they're cross-shopping, they're buying clothes, they're dining out, they're doing things that are more than just working out.
They're working out and walking into both retail and restaurants.
I do find myself sometimes just spontaneously going to the mall after I work out just because it's convenient. And to be honest, sometimes I'll go to the mall as a little treat if I have a really good workout.
There is no specific data yet showing whether gyms do drive more traffic to other parts of the mall, but Corradino says he's definitely seeing it anecdotally.
The test for us is we like it enough that we're doing more of these, right? We're not just doing one or two or the one here today. We're about to open one in a Washington suburb, and we've got 3 or 4 in negotiations right now.
And the strategy benefits both the malls and the gyms.
It's a great partnership because the mall can feed off the gym and the gym can feed off the mall.
And that opens the door for cross promotion. So maybe you put a fitness apparel store or a juice bar on either side of the gym, or put it a few doors down and make your gym goers go further into the mall, because time in the mall is money.
My younger days, it's a place to hang out, movies. Now it's just, being older, it's just, okay, what do I need? Can I get in and out quickly? Otherwise, I'll purchase online.
Just the kind of mindset that has landlords in a sweat. For Nightly Business Report, I'm Diana Olick in Hyattsville, Maryland.
And to read more about how malls are courting gyms, head to our website, nbr.com.
So now there is really no excuse for not working out.
No, that's right. You can go there and then you can treat yourself.
And treat yourself. We'll see. That does it for us tonight. I'm Sue Herrera. Thanks for joining us.
And thanks for me as well. I'm Tyler Mathisen. Have a wonderful evening, everybody, and we'll hope to see you right back here tomorrow night.